NVIDIA stock is currently trading at exactly $214.68 per share during today's intraday trading session on Monday, June 1, 2026, reflecting a modest positive tick of 0.20%. While a superficial look at the screen shows a relatively quiet day, the true story is found behind the scenes, where institutional algorithmic blocks are positioning themselves for a tectonic shift in enterprise infrastructure spend. The typical retail narrative assumes the massive infrastructure build-out is nearing completion, but internal order books suggest that we are entering a phase where computational capacity constraints will force a complete re-architecting of global data centers. The prevailing market expectation is that chip demand must eventually normalize, causing a cyclical downturn that historical chip makers have never escaped. Investors often assume that once major hyperscalers fill their initial server racks, procurement budgets will inevitably tighten. However, the reality of the situation is that chip design complexity is accelerating so rapidly that earlier hardware iterations are becoming obsolete far quicker than standard depreciation schedules predict. This creates a perpetual replacement cycle that conventional equity research models struggle to quantify. For individuals navigating these volatile tech names through an online investment portal, self-investing has shifted from a game of simple growth chasing to a sophisticated exercise in understanding hardware lifecycle dynamics. Looking at recent market movements, NVIDIA stock has bounced between a 52-week low of $132.92 and a high of $236.54. The stock is currently trading right in the middle of this wide range, consolidating on a heavy relative volume of 289 million shares compared to its long-term historical averages. This massive volume signals that long-term funds are aggressively swapping positions with shorter-term traders who are taking profits after the recent quarterly report. We are seeing similar consolidation across mega-cap tech, with Apple stock showing tight trading bands and Tesla stock experiencing heightened retail volatility across major investing sites. If you look closely at institutional order routing platforms, a large portion of this volume is being driven by automated block trades executing across the Interactive Brokers platform, where professional managers are adjusting their weights for the second half of the year. The broader semiconductor sector is facing a distinct macroeconomic backdrop marked by sticky interest rates and fluctuating capital expenditure projections for mega-cap buyers. This has forced retail participants on the Robinhood app and alternative Robinhood stock trading avenues to reevaluate their leverage. When you use a modern Interactive Brokers account or scan the Robinhood platform for retail sentiment indicators, you notice an underlying tension. Traders want to catch the next leg up, but they are terrified of a sudden valuation multiple contraction. Comment below how many shares of NVIDIA stock you currently hold in your portfolio right now. To truly understand what drives this $5 trillion enterprise, we have to look past the intraday price action and analyze its underlying business engine. The organization fundamentally operates as a fabless architecture designer, meaning they design the highly intricate silicon layouts and proprietary software frameworks while outsourcing the physical fabrication to specialized advanced foundries. Their core business model relies on maintaining an ironclad grip on the compute layer of modern data centers through a tightly integrated ecosystem of hardware and software. By providing not just the physical silicon, but also the critical software compilation layers that allow developers to write optimized code, they have built a moat that makes switching to a competitor incredibly expensive and logistically painful for enterprise clients. Past financial disclosures show a business that has historically generated staggering net profit margins exceeding 55%, alongside an explosive return on equity that completely distorts traditional valuation metrics. For long-term investors who use classic tools like Fidelity mutual funds or build their own baskets via self-investing setups, these numbers have long justified a premium valuation. While old-school fundamental analysts using standard Fidelity brokerage accounts might look at a price-to-earnings ratio above 30 and call it overvalued, the company's ability to turn nearly two-thirds of its top-line revenue into pure operating cash flow gives it a balance sheet strength that few entities in corporate history have ever achieved. When you look at how this fits into the wider retail ecosystem, individual investors are increasingly utilizing automated tools to manage their tech exposure. Platforms offering features like the SoFi Robo-Advisor, where the automated allocations of Schwab Intelligent Portfolios help cushion the blow of these massive individual stock swings by rebalancing into broader asset classes like Fidelity ETFs. Yet for those choosing the path of active online investing through a dedicated SoFi Active Investing account or a standard Fidelity trading platform, the temptation to trade the individual swings of high-beta semiconductor names remains incredibly strong. The accessibility of fractional ownership through Robinhood fractional shares has only amplified this trend, allowing smaller accounts to participate in institutional-grade price movements. As we look toward the future horizon, the multi-year outlook for the enterprise depends entirely on whether reality can keep up with the sky-high expectations embedded in global infrastructure budgets. The primary catalyst to watch over the coming quarters is the rollout of their next-generation architectural platforms, which promise to significantly lower the power consumption requirements of large-scale cluster deployments. If these new systems can successfully ship without manufacturing bottlenecks, it will validate management's projection that data center capital expenditures are on a clear path to hit unprecedented global levels by the end of the decade. This would easily sustain the company's revenue growth and force a massive upward revision of long-term earnings estimates across Wall Street. However, the risks to this optimistic thesis are substantial and deeply structural.
The most pressing threat is the physical capacity limit of advanced semiconductor foundries, as any supply disruption or yield issue at the manufacturing level immediately caps the company's top-line revenue potential, regardless of how high client demand might be. Furthermore, macroeconomic pressures could force major cloud providers to slow down their infrastructure build-outs if consumer-facing software monetization fails to scale fast enough to justify the massive hardware expenditures. If hyperscalers decide to extend the life cycles of their existing server installations even by a few quarters to preserve cash, it would trigger an immediate and severe order digestion phase that would hit the stock hard. For individual retail traders executing orders via Robinhood crypto and cash management accounts, or long-term savers managing retirement capital within Fidelity IRAs, balancing these structural risks against the clear growth opportunities requires a disciplined approach to asset allocation. Relying on an individual brokerage account to catch short-term momentum can be rewarding during a secular uptrend, but it leaves investors highly vulnerable to sudden shifts in broader market sentiment. This is why a growing segment of the market is shifting toward balanced frameworks, utilizing sophisticated online investing sites and robust wealth management services to build a balance base before taking tactical single-stock positions. Ultimately, the structural tension between market expectation and fundamental reality will continue to dictate the long-term trajectory of this technological giant. The investment community expects a flawless execution of product roadmaps and a permanent expansion of computing budgets, leaving virtually no room for operational errors or macroeconomic slowdowns. The reality is that while the underlying demand for advanced computational architecture is real and growing, the path forward will be marked by intense capital constraints, manufacturing complexities, and inevitable regulatory scrutiny over market dominance. Investors who look past the daily noise of the market and focus on these core structural dynamics will be far better positioned to navigate the volatile landscape of a modern technology sector. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.